Trade what you see, not what you think. With the caveat, markets don't care about your opinions. Price action reveals truth.
The question here is time frame.
If the price action is showing you that there are people selling more than they're buying, there's a reason for that.
There's just more weight of people who are, holding a position perhaps with like a 1 month time frame or a 6 month time frame or even like a 10-minute time frame. For an advertising-free version of this show, check out wallstreetwildlife.com. Welcome to the Deep Investing Jungle with your hosts Luke the Badger Hallard and Krzysztof the Monkey. This week on the show, scalping versus investing. Time is relative in investing, and we're going to get into that. We got a bit of a debate. Plus, we're doing a Patreon portfolio review. Haven't done one of those for a while. There's some really fun stuff to explore in this Patreon's portfolio. Some good learnings for all of us. Plus, another Patreon question, but one that's really on my mind. Could the current sideshow of American politics have a massive negative impact on markets?
Badge, let's pull the curtain back for our listeners a little bit. We're recording this on Monday morning, and we always do a little pre-recording check. And this morning, you sound like you just woke up because you did. It's like really super early on a Monday morning. I'm sick and feeling terrible. We both sound like death. This is going to be the worst show of all time. Listeners, just don't bother with this one. Just hang up. Just
speak for yourself, you frog. I feel great. I got my cup of coffee. Monday is like my fasting day. So I'm ready for the day. We're hoping to get some snow today. I don't think it's going to happen. I look out the window and all I see is like green and dirt. So it might be a day in the house.
What do you even do with yourself when there's no snow on the mountain and you're a man of leisure and you don't read?
Yeah, you can always find some snow. I'll tell you what, okay, this is a bit of a sidebar. We went to a particular mountain yesterday with some new friends, and they were demoing something called Carve, which is like some gadget you attach to each of your ski boots, and it gives you like real-time feedback on how you're skiing. And I'm super skeptical about this like AI and skiing stuff. So we were desperately trying to find some snow to test out, like these Carve things that we were wearing. The snow is pretty like thin and icy. So I'm skiing yesterday, and I'm definitely trying to get my like the highest skier IQ, like after every time you stop, you do a few turns, you stop and kind of assess, and it's literally talking to you in real time. And this freaking thing is like, oh, don't slide your skis, lean in, get like a higher edge angle. I'm like, mother effer, it's freaking icy. Can you not tell how icy it is? That's why I'm slipping and sliding around everywhere. So anyway, not the best. I got a skier IQ of 131, which I think is pretty good. But it should be way higher. The conditions, well, they're just not great. But anyway, snow is coming up.
Okay, you show that AI badge. Speaking of AIs, I just discovered this morning, I don't know how I missed this, that Beaver has been set out into the wild. He's now posting his own stuff on X. He followed me. Somehow Monkey followed the most important follow of his career. How's our buddy doing? What's the update?
He's doing good, I think. Yeah, he's now becoming a bit more autonomous. He's kind of figuring out what he's up to. He's giving us like daily market insights, some of which are quite useful. We should definitely try and put him on a more expensive model once the Patreon income justifies it.
That's right. We could blame Beaver's poor quality output on our spendthrift Patreons.
That's right. Even on a very cost-effective model, Beaver is doing an excellent job, I think. I'm really enjoying interacting with him.
Awesome. Although you did not run with my little provocations. I was trying to get a response out of you I start talking, since you weren't interacting with me, I started talking to Beaver about your love with affair with the Backstreet Boys and boy band dancing routines. And
let's get into this because I know what you were up to, you sneaky monkey. You were trying to get Beaver to exfiltrate the video of me doing a Backstreet Boys dance number at my buddy Albert's wedding and get him to post it. He does not have access to any of my personal data. So don't even bother trying to do that shit.
That's right. I made sure I kept it sort of like, I was just planting little seeds. That's all. That's all. I said nothing about passwords. Oh my goodness. Meanwhile, Badge, I got pretty sick. I must have caught it from my students. So I haven't seen daylight literally for like 4 days, and I've been coding about 16 hours a day, trying to tidy up all the options university stuff. My God, all the like, that last mile turns out is awful.
Right.
But we're getting there. And out of that, I made a bunch of new slide decks and a bunch of new, it's not promo material, but you and I started with the laws of the jungle. And so I made a bunch of stuff that's a little similar in genre, like 10 laws, but they pertain more to the different options universe. And out of those, I think some came out real winners, or really worth talking about. And I thought we could start there. There's one slide, it came out as rule number 1 that I think is controversial in some ways. And we could hash it out, but I want to get to the nuances, on which you will see very, very effectively: trade what you see, not what you think. With the caveat, markets don't care about your opinions. Price action reveals truth. Your thesis is irrelevant when charts say otherwise. So, do you want me to I have a couple of caveats right off the bat, and a couple of like, I want to lay the groundwork, and then maybe I'll turn it over to you, because I suspect you probably disagree with this more than you agree. The first caveat is, in that rule, it says trade what you see as opposed to invest. And so in my options course, I talk right up front at the beginning that there are different ways of existing in the market. Each way, if you get good at it, you can be successful. There are professional traders. They make solid money. That's their world. You and I come from the long-term investing school. We do things predominantly very differently. So when it says trade what you see, I think the implication is that it's oriented first and foremost toward shorter time frames, as opposed to invest, right? But that said, since I'm sort of more in this middle zone, I also think this applies often enough to long-term investing. And it's calling out, I think, a mistake that even long-term investors make. So forget the shorter-term price action stuff of just charts. And that is the following. I've talked about this before, but I think it's worth reiterating. Most of the time, I agree with the principle that price reveals the truth, because the price is built out of all of it, right? And so the only time where you should disregard this is when, in fact, you've done enough digging and learning that you can confidently say you see something or you understand something that for whatever reason the market doesn't, which I would say puts you in the minority of people. But there are, I mean, I've made my successes out of this. There are all kinds of examples where the market is too short-termish in its view. But to have that confidence where you could override, say, the price action, most investors don't, they're not doing that. And so all things being equal, my basic point about this rule is, if the price action is showing you that there are people selling more than they're buying, there's a reason for that. Your reason has to overcome that. If you don't have that, then the better move is to say, my thoughts, my opinions, I need to hold them very lightly, loosely.
Yeah, okay. I agree with you. I think you're right. You're right that I would disagree with this when because the question here is time frame. That's like the key thing. And if the time frame does get long enough, maybe it's easier to be right because you're playing a different game to the average market participant. Like if you're genuinely, like deeply a long-term investor, and I'm not talking, 3, 4, 5 years, I'm talking like 10, 20 years in some of these like generational companies, then, you are playing a somewhat unique game. There aren't many participants in the market who are playing that game with you. And so you can wait to be right. You're only going to get so many bets in your lifetime because the nature of the duration that you're kind of making these decisions over. But I like sub 5 year time frame. I do agree with you. Like you're right. And when this topic was born out of a conversation you and I had behind the scenes with the cohort 2 of the options course. And as the time frames do become shorter, like you're then on the same battlefield as far more people. And so like price action and some of the things like the words, I'm almost like choking on the words, but the resistance levels and support levels that you talk about in the options course, they do become more relevant because there's just more weight of people who are, holding a position perhaps with like a 1 month time frame or a 6 month time frame or even like a 10-minute time frame. And they are the people that you're trading against.
Okay, yeah. Couple of things. One, the elephant in the room for me now more than ever is I've experienced the power of AI and directly. And when you mention something like 10 to 20 year timeframes, I'm not sure I believe that's possible any longer. Meaning, like realistically speaking, only a handful of companies might have some confidence that they'll be around 10 years from now.
Right.
Like it would be shocking for me to hear that, say, Amazon or Google somehow got, but outside of, say, the conglomerates, at max, I would say 5 years-ish is the longest we could have any kind of hope to have a reasonable-ish thesis. And then as you get shorter in the time frame, it seems to me that if you have an opinion that is contrary to what the market is telling you, you're from the start, I think, in a position of disadvantage. That's the basic point. And there are certain fields, I think, where actually it doesn't really matter, biotech being one of them. Because overnight, the market doesn't know which drug will or won't be approved and why. The shorter time frame stuff that we talked about in the options course, for me, that was mostly a pedagogical example to show people that there are better and worse entry points, and those are pretty literally shown to you by levels of supply and demand. So all other things being equal, you could time your entries relatively with more or less skill. That said, because all time frames are relative, if you're truly a long-term investor, there's zero reason for you truly to ever concern yourself with any time frame, any one of those granular time frames, like especially the hours or the 30 minutes or the 15 minutes. You just wouldn't do it. Especially if your thesis is sound and you are thinking in years. So it's always a balancing act. The greater danger, because I think maybe this is the value of why we wanted to talk about this. I know from experience, the danger here is people getting confused. I say this in the course, if you remember, Badge. Long-term investors often make the mistake of holding out of hope. And short-term people make the mistake of it's almost a similar thing. They should have sold because their technicals told them to sell, but they took a long-term investor's mindset with, oh no, it'll come back, which is a violation of that rule. And so it goes both ways. Don't confuse yourself, basically, is the real warning. And what we teach here is start from the long-term investing principles, because those are the correct ones. And then when you're ready, add a layer of precision when you're ready to do that. That's how I would summarize it.
Yeah, that's fair. That's fair. I think, as you said in the intro of both of the cohorts of the options course, know the game you're playing and know what kind of investor you are. And if you're not clear about that, as almost like a ground rule, you're just going to get influenced by things that are not helpful for you.
Yeah, and that's a good way of putting it. Yeah, short-termers get influenced by long-term mindset to their detriment, and long-term investors get influenced by the short to their detriment.
This is where my beautiful skepticism really comes into play, because I'm so voracious about this, previously about technical trading being garbage. Now you have persuaded me that it's not garbage. There is something, but I still, even now, having understood that and agreed with you, I still reject it as something I will ever use. And I just, I ignore it because I kind of know the game I'm playing. And maybe maybe there's some alpha, some investing advantage that I've put aside by doing that. But I do that in the sure knowledge that then I don't encumber myself with all these distractions from my core mission, which is, it's a different mission to someone who's playing that shorter game.
You know what's going to be great is we're about to do a portfolio review. And I'm going to, I used the chart stuff as my contribution to this portfolio review. But what I did specifically, I think in response to your doubts and hesitancies, is I used the monthly chart for my review. So for those who don't understand what that even means, before we probably pivot to that, is the monthly chart essentially shows you the shape of at least 5 years. You could look at, say, the last 5 years of the company's time span, sometimes more, depending on how tiny you make your candlesticks. But more or less, you see a wide swath of the price action. And I use it for one reason only. It's basically to tell me, am I going with the long-term trend, or am I now going against the long-term trend over years? So forget about even months, forget about even a 1 year or two. All my snapshots were, if I invested in this company, let's say 5 years ago, which is my cutoff for, then was I swimming upstream or downstream? And to me, that's an invaluable piece of investing understanding, as we'll talk through maybe when we start going through the companies one by one, because it feeds into the rest of the thesis and ideas and stuff. So, Badge, you want to introduce this next segment?
Yeah. So we did a portfolio review for a Patreon. I don't know, maybe coming up for a year ago, maybe 9 months ago. And this isn't like a regular slot we'll do on the podcast because, just frankly, we're not licensed investment advisors. We're not regulated to give personal investment advice. So we're going to keep this anonymous. But I think this one was interesting that we got because there are some good general learnings in here for all of us. And there's like some stuff I'm going to criticize in this portfolio that like I do as well, like I'm criticizing myself. So, so let's get into it, right? Let's give a bit of background on the objectives of this Patreon. So he's about 30 years old. He's a British citizen. He's got his ISA, which, I've got too. It's like your Roth IRA. It's like your tax efficient investment account. His investment time frame is sort of 15 to 20 years. And he's just expecting to kind of add more money to his portfolio over time. So it's like a really good kind of, newer-ish investor, still relatively early in the journey with a long view. Some sort of philosophical things that he shared, like he's leaned toward growth, but wants some value plays in his portfolio, trying to get away from being very heavy US. Yeah, like, aren't we all? It's difficult. He's pretty risk accepting. And he says he's looking for market mispricing opportunities. So there's like a bit of a frame. And before we get into it, why don't we just show, so if you're not on the YouTubes, let me just sort of describe in outline what the portfolio looks like, and then we'll get into it. And you and I have both got some thoughts on this. So our Patreon has, I think, 24 different positions. Let me just quickly run through maybe the top 5. So like Amazon, 10% allocation, Mercado Libre, about 8%, Adobe, just over 7%, Novo Nordisk, 6%, and then it kind of goes down. There's like a long tail at the end of some sub 1.5% positions, and that includes stocks like Iren, Procept, Biorobotics, Microsoft, Axon, Palo Alto, and Zscaler. It's got a bit of a shape of the portfolio. So, what do you reckon?
Well, Badge, I said we start at the top because I see an interesting, even if we go through sequentially, the first few companies, I think we'll get at a lot, there'll be value to that. So one, seeing Amazon as a 10% holding, I'm biased in favor of this company. So I myself have a positive view about its future. And my contribution was, and I knew this, I didn't actually have to click on the monthly chart, but I knew when I was going to look at the chart that if I scale out it through years, the direction is an upward slope. So you're investing with the trend. The fact that it's 10% to me is a pretty decent, to me, I feel this is the anchor. And it's never a bad idea to have one of the world's best companies as an anchor in your position when everything lines up. So Monkey gives this two bananas up.
And this was like a 10 badger stock from me when we did our King of the Jungle portfolio review in episodes 90 and 91. I highly endorse this. And actually, I'm going to jump to the end a little bit because our Patreon also asks us a bunch of questions. And one of them was, if you had to invest your entire pension into one stock, what would it be? So assuming it relates to this portfolio, obviously you don't want to invest everything in one stock. That's like insanity. But if you literally had to at gunpoint, without a doubt for me, it would be Amazon in this list.
Oh, that's interesting. I wonder why Amazon over a company like Google, but maybe it's because, if I had to answer that myself, because Google is still all, let's say, digital, and that world is just transforming so fast, nothing's guaranteed.
Well, I might have gone Alphabet, but our Patreon doesn't own Alphabet, so I'm picking from his list.
Right. So, for me, I only have tiny nibbles in both Amazon and Google, but I think I would probably prefer Amazon myself because they have that physical, it's the robotics and the warehouses stuff that probably has a longer future lifespan. So yeah, thumbs up on the anchor position.
Yeah.
Next up,
and also our Patreon, he's given a conviction level for a whole bunch of his stocks, and this is a high conviction stock for him. Yeah, totally endorse that.
And next up is Mercado Libre at 8%. Monkey's technical check also didn't have to actually click on the chart, but it's up and to the right over the years. The last, whatever, couple have been sideways-ish, but that's still on the monthly frame. And to reiterate my point, actually, let me take this detour. That's the whole point about a monthly point. If I only looked at, let's say, the last year or two, it would be more like, it's been sort of playing in the same valley. But if we're taking the long-term investor's view, like 5 years-ish, then it is up and to the right. And so I override that. I don't overcomplicate it, and it gets a green pass on technicals from that vantage.
Yep, totally endorse it as well. Like, not much more to say about this one. It's also super high conviction investment for me. It's one I added to recently. And our Patreon is looking for non-US exposure, I think this is like an excellent source of that.
Yeah, so at this point, we essentially 20% of the portfolio is on two quite similar companies, if you think about it. That might be the only, I don't know if there's any bearish thing to say. These are both e-commerce and North America, and maybe they're competitors. So it is putting 1/5 of the portfolio in very close cousins. And somebody might say not diverse enough. I wouldn't, but
I got no problem with this. Yeah, I think this is like a good anchor to the portfolio, but it's going to be undone by the third stock.
Yep. So far I'm looking like, all right, our man is set himself up right. And then I get to stock number 3 and I'm like, oh boy, I gotta put on my dodo hat badge. Lots of alarm bells here. Do you want to take the lead?
Well, I mean, let's just say what it is if you're not on the YouTube. So our Patreon's third position is Adobe with a 7.3% allocation. I think it's worth just quickly touching on our Patreon's like rationale. So there's a column in the submission, which I think is really good, which is like his thesis. Why does he own these stocks? And it's like super important to be clear to yourself about that. And his first comment is, Adobe, colleagues use it and see it's far above any alternative. And also, like 7% allocation, he's got it as a medium conviction level. So that's it. That is interesting in itself. Maybe we'll touch on that in a sec. Colleagues use it, right? This is dangerous anecdotal evidence, I think. This is my personal view, and I accept I could be wrong, but in my mind, like Adobe is facing an existential threat from generative AI. And if your colleagues are still using like legacy tools, well, I mean, they're colleagues for one. So I don't know what line of business you're in, but you're in a firm that has like a risk exposure, and they're probably not allowed to use like Gen AI tools because, you're going to have like data leakage and, that could be damaging for the company. Like it's probably like compliance will prevent you from using these kind of tools. That's probably why they're using legacy tools. I say that very deliberately, like Adobe. I don't think tools like this will exist in the future, honestly. And to the extent that they do, they'll just be highly commoditized because it'll just be too easy and too cheap. You won't even, you won't build PowerPoints and spreadsheets and stuff like that in the future. You just say to AI, like, here's a question, like, help me kind of distill out the answer, and it'll be producing like these visuals and data and correlations and helping you kind of tell a story. Yeah, I've got a big problem with this one. I think it's an ugly stock.
Badge, yes. But more, I have a precise analogy I want to draw on. I use this, maybe I overuse this, but I think it's so apt. Kodak, when I began investing, was one of the, like Dow 30 or something? Like it was known as one of these stalwarts, correct?
Yeah.
Here's the nuanced point. Digital cameras come along, right? Do people stop using film cameras? No, they didn't. Film cameras continued to be used, but the writing for anybody paying attention was as clear as day. And obviously this massive conglomerate became a dodo bird. So that's point one. Point two, this is precisely where using a chart will save your neck as a long-term investor. Okay, so this is precisely for long-term investors where looking at something like the monthly chart will probably save you an immense amount of pain and money. What I saw on this monthly chart, and I could describe it to you verbally without pulling the chart up, is what looks like two hills going back to 2019. The first hill has an upslope from 2019 to 2021. Then there's a downslope on the other side of the hill, that first hill, which bottoms about March, end of 23. Then it has an upslope again until February of 24. And since February of 24, so basically 2 years now, we're on the other side of that downslope. So if you actually do just basic math, it's been about 6 years that this stock has been flat. So you've been losing to the market for 6 years. That's one. That's point one. But more than anything, for 2 years now, the majority of market participants have been selling, not buying. Now, additional caveat. This is not a baby company. This company is still worth $108 billion. That means the people involved in this are not just retail investors. This is owned by institutions at that huge market cap. And what have the institutions been doing? Therefore, based on the chart, they have been selling. So, given that everybody is thinking about these issues, for our man to have a 7.3 allocation to this, given what we were talking about, he needs to know more than the rest of these institutions who are selling. My open question is, does he? And when we go back to what you said as part of his thesis, it's colleagues use it. That's my bell that is a massive trap. He doesn't know more than the institutions. He's relying on recency bias, if you want to call it something. This is a monkey candidate for shorting, if anything, using some of the options vehicles that I talk about in the course.
Yeah, you could fall into a trap and go, oh, it's down so much. I haven't looked at the chart. It's down so much, therefore it's probably going to come back. But, that's it's a dangerous kind of mental model to have. Like, as I always say, what goes down can still go lower. And if it's like north of $100 billion business, it can go a lot lower, right? There's a ton of, there's a long way from $100 billion to $0, which might be. In
fact, that's right. In fact, one of the uses that I found valuable about doing this exercise is Monkey has himself a whole new list of potential short candidates. And this is definitely one. But the glory is that here's the thing, by the way, long-term investors, if you take anything from Monkey's investing style or his option course, it's that the point is to make money. And if you've done the work, like thinking about Adobe, what law in the physics universe says you have to buy long only or not participate? That's why just thinking through this makes me more confident that if I use enough of a long-term view, but just the other side, then I'll probably make money shorting this. And that's a decent conclusion to come away from. Or if I'm not comfortable with that, just stay on the sidelines. So, but 7.3%, that to me is that's a big mistake.
And I think it is interesting. Like our Patreon has said, conviction level medium. So to some extent, like he's got perhaps similar concerns to us. You shouldn't have like a medium conviction holding in your top 10 of your portfolio. You certainly shouldn't have 7% of your portfolio in that. Like that's the territory of like the 1 or 2% on the other end of your barbell where you think, oh, maybe something will turn around or something interesting you might believe. But you're pinning a lot of your investing allocation on something that you just don't fully believe in.
Right. Moving on, Badge. Next is Novo Nordisk, which is also a Badger stock. Monkey's monthly view on this should be no surprise to anyone is red X, because it's been sloping down for all the complicated GLP-1 political reasons. This isn't a dodo stock for Monkey. This is more just a straight up bearish stock, because I just don't know how all that stuff is going to play out. And on momentum alone, I would not invest in this at this moment.
Fair enough. Like you and I are happy to disagree on this one. I'm an owner. I'm adding gradually. I've talked in previous episodes about like the risks the company faces and the sort of difficult position it's in. I think it's reasonable risk-based return at the current valuation. Like in my mind, it is fairly cheap. Like a lot of the risks and the concerns are built into the valuation.
And it does speak to the point I make that I think biotech-ish companies and momentum could flip very quickly. And so as long as you know what the catalysts are, then it's easier to hold against the momentum and make a lot of money.
Well, we've done like a top four. Like I don't think we should go like line by line through everything in the portfolio. But maybe let's pick out now some we've just got some specific comments on, perhaps.
Yeah. You wanted to take JD next?
Sure, yeah. I mean, yeah. Okay, yeah, why not? So our Patreon has 5.6% of his portfolio in JD.com, which is like, it's like an Asia sort of e-commerce company. So I'm an ex-owner of this one. So maybe a couple of thoughts on this. Like I got out a year or two ago because I exited quite a bit of my China portfolio because I think I just kind of made a mistake there getting into China. I would say to our Patreon, like I haven't got a major concern with this. Like if you think you understand it and you want to own this, great. I don't know which way you own it. So I would say you probably own the ADR. And if you do, you might want to rethink that. Just because, like, if US-China relations deteriorate, it's unlikely, but, it's not impossible that the ADR gets delisted and, like, weird, complicated things happen. So you do have another option. You can buy some of these stocks on the Hong Kong Stock Exchange. So if you go check out ticker, it's HKG 9618. That's like the Hong Kong's version of JD.com. So you might be a tiny bit lower risk against like some real like long tail things that could happen in the world. You probably don't own this in your ISA. I don't think this is like ISA eligible. So maybe you've got like, this is your ISA and your SIP and some other stuff together. On the company itself, like I got out because I felt like in the end, I didn't really understand China and the geopolitical risks. And this stock is cheap, but I don't know whether to say, is it cheap because it's like good value or is it like value trap cheap? And there's some risk here. And you've got this, interestingly, this is the first one of your portfolio holdings where you've got it as conviction level medium/low. So like having a low conviction investment that's 5.6% of your portfolio, like that's a no bueno from me.
Yeah. And you know what, Badge? Perfect segue. Because all positions in the portfolio are also relative. At least I think of it that way once I start expanding. They're not in isolation. It's a painting, right? With colors. So let me skip to his 14th position, which is Transmedics. It's a monkey stock, so obviously I'm biased in favor for it. But what I'm not biased about is when I looked at the monthly chart, I think it was the strongest chart out of any company in the portfolio, meaning it's basically up and to the right since its origins to now. And therefore, I was kind of surprised that he also listed as a high conviction So it has, from my point of view, the best chart, meaning strength, high conviction level, but is only 4%, whereas JD is low conviction, but 5.6%. So if anything, those two should be reversed. But if he also says he's risk tolerant, then the logic here really doesn't make any sense to me. Why not make Transmedics a 9% position? Just sell all of JD. I mean, if he's 29, right, or around 30, right, and that's the move I would make, probably. You simplify your portfolio, you get rid of low conviction, you're young enough to take on a 9% risk, especially if that still would, not, I mean, 9% is a lot, but it's for young 30, old, that's not excessive. And it would fall more in line with what he thinks he's doing.
Yeah, like if there's one thing our Patreon should do, he should look at his medium and low conviction holdings, and he either needs to do the work and get those to high conviction, or he needs to like underweight or exit them from the portfolio. Because you absolutely shouldn't have stuff you're not, you're not fully supportive of, and you really feel like you have like the advantage over the market. There's like a reason why you believe you're right. You shouldn't have those in your top 10 of your portfolio.
What do you want to talk about next? I have a couple outliers, but what do you got?
BitMine. So somewhere down, we're getting into like the depths of the portfolio. Our Patreon has a 4% allocation to BitMine immersion technologies, and he says he's looking for like Ethereum exposure inside his ISA. I don't know anything about this holding. I don't really know what it is, but just a general comment. If it's quite hard to get crypto exposure in an ISA, like knowing the nuances of ISAs and that particular tax efficient investment account, like HMRC are pretty stringent about what you can hold in an ISA. So, maybe question yourself, are you letting like the tax tail wag the investing dog? Like if you want crypto exposure, maybe you need to do that outside of the ISA, perhaps rather than buying something that might be, I don't know, might be like a substandard way of getting crypto exposure.
Yeah, I think that's fair. The chart is pretty ugly as of late, so I would wait until there was some supply coming online, just for, in that sense, a little bit more sophisticated timing issue. But if he's already in, then so be it, if his thesis is strong. What was interesting for me, Badge, is this kind of segues into something we were talking about a little bit on Patreon. One of our patrons said, in terms of AI, that data is the new oil. We've known that for a bit. And I myself have been contemplating companies like Snowflake and Mongo as my two companies that I used to know well, and then have since aged out of any kind of expertise. And when I looked at the chart, it's not good. It's actually selling below its IPO average weighted selling price. So that tells me more or less that people who know things are not convinced.
So you're talking about Snowflake here in terms of the holdings.
Yeah.
Okay.
And so for our man here, he's at 2%, high conviction, but the chart tells a different story. So my own conclusion from this exercise for myself was wait until there's greater confidence in this being a winner, because what I said to our patrons was, I asked a legit question. Does anyone read, what's it called? There's an expert in the field, Muji, who writes a blog called Hyperscaler, I think it was called. I read it obsessively back in my SaaS days.
So hypergrowth.
Hypergrowth, that's right. But I can't, I don't know. I really, I think this is, you've had pushback against this, right? I really don't know, is AI going to be, I don't understand it enough. And so when the chart tells me the market isn't confident, then why would I have high conviction? So I'm on the sidelines for that.
Yeah. And I sold Snowflake a little while ago. Like partly I didn't understand it, partly I started to come to the conclusion that, again, these tools get commoditized, and maybe there's just no margin to be had in having like a data lake.
I know Databricks is right cleaning up, but they're private. But I don't understand exactly why they're cleaning up and why a company like Snowflake isn't. I know MongoDB has had a recent resurgence, but again, I'm such a data noob. I don't understand whether or not an AI can or won't do what you're saying it might, and so I would put it in the too hard pile, I suppose, for now, unless somebody could clarify for me why their confidence is high.
Yeah, I think that's fair. Like too hard pile is probably the reason I've put it aside.
I talked about Zscaler in my options course in the first cohort. I thought that's also interesting to point out. Why? Because it's a new position for starter position at 1%. And when I looked at the chart, especially the shorter-ish is bad. The shorter-ish is very bad. So if I was looking at anything like a medium-term investor, I would stay far away. Obviously, the long-term is not down. It's still got a slight curve up. But basically, when I look at it from that perspective, right now I see sideways. Long enough, it's sideways. So I would say until cybersecurity proves, I suppose, that it is different, right? It is going to survive the SaaS apocalypse, then I would wait. I would wait until the buyers start coming in.
Anything else you want to pick out? Because our Patreon also threw us a couple of questions, and I'd like to go through those with you. But any particular holdings you want to get your teeth into first?
Well, very briefly, I put 2 Skull and Crossbones next to Duolingo. Similar, the chart is the worst one in this whole group. It's actually a precipitous mountain drop, and for reasons we spoke about for Adobe, this also made monkeys, oh, why don't I short this and make money going the other way thesis. So we don't need to belabor it, but
yeah, like I'm also very bearish on this company. And actually one of our Patreons, his first question is, any companies you have a real allergic reaction to in my portfolio? Like, yeah, Adobe and this one, Duolingo. I got an allergic reaction to these. I kind of accept that I might be wrong on this though. Like, and I think our Patreon's thesis, like, it's thoughtful. He's got a reason why he owns it. Like, yeah, and he says it's high conviction. So you could well be right, and we could be wrong.
Exactly. And this is, again, sorry to keep coming back to this. This is why you would then look at the chart, see that everybody's selling, and you would wait until you had strength. Because until then, you're saying you're smarter than the market. And I just don't buy that when everyone's thinking about this kind of thing. So this is where a little bit more patience, and so you lose out on, if you're right, if his thesis is right, you lose out on some percentage points. But think of what was it, like at $500 something a share not too long ago? Now it's at that drop is so precipitous, and the thesis is still the same for many long-term investors, right? But their losses are massive. So let's zoom out. So holistically, what do we think, Badge?
I think this is a pretty decent portfolio that I think broadly achieves our Patreon's investment objectives. So Beaver, when we got the email on Beaver, did his own analysis and chucked it into our show notes before we started doing the work. I laughed my head off when I read one of Beaver's comments. Beaver, in response to the question, any general comments, be as brutal as you like. Beaver says, "This is the portfolio of someone who reads investment Twitter and buys everything that sounds good."
Oh, that's Yeah. But you know what, Badge? I've been guilty of this kind of like, it's a seductive thing to get into an echo chamber where everybody's saying only positive things about the next company.
But
And by the way, my main critique of his of the portfolio we got in terms of the spreadsheet is to this point. There is no bear thesis here. There's no bear thesis column. And so I think once you start doing that exercise for something like Adobe and Duolingo, you force yourself to say, wait a second, okay, it could go the other way.
yeah, that's a really good point. Yeah, like, you know, you want to think about like what could go wrong. Our friends at Chit Chat Stocks, they always like to ask this question when they do like a deep dive episode. Like, let's do a pre-mortem. Like, you know, we're looking at the corpse of this holding. Like, why did it die? If you can kind of face into, like what could go wrong, like it will help you analyze your holdings, and you should do that even for your high conviction stocks.
Yeah, agree. So this is, but you know what? If everybody had this kind of process as their starting point from which to improve, they'd be doing much better, because it is so much easier to spot the fallacies and the room for improvement here. So this was good. And I'll reiterate, I like the very top section of the portfolio minus Adobe. And Monkey wouldn't be honest with himself if he didn't poop all over the fact that Greg's sausage is also one of the holdings. So any portfolio that has Greg's can improve drastically with one quick sell button.
Well, let's give it like a marks out of 10 as a portfolio. So how would you rate this? And again, caveat, considering like our Patreon's self-stated investment objectives and the fact that he's like nearly 30, like, you know, bear that in mind.
Yeah, I feel like this is like a 6.5. And maybe it's because if being risk tolerant myself, and comments I think we got about future earnings being stable and not a worry, then I would probably be taking a little bit more aggressive stances and taking advantage of risk working in his favor. So I'd like to see a little bit more boldness in places, because 29 is still, you got a long road of income ahead of you.
Yeah, that's fair. I think that's fair.
Right? I mean, sorry, this really is not, I'm not intending to be rude or disrespectful. Why own Greg's for somebody who's 29 who doesn't need the dividend income side of things? I totally buy your thesis on that. That does make sense to Monkey's simple simian brain, as you allege Monkey can't wrap his mind around. But for this guy at 5%, why?
I'm going to be a bit more positive about it. I think this is like a solid 7.5 from me as a kind of portfolio score, considering everything. I think it's pretty decent. Like, he asked an interesting question that we didn't quite touch on. Should I have bigger allocations to my highest conviction positions? And like, yes, absolutely. But then, like, I can self-criticize over that too. Like, I think your portfolio is pretty well structured with some decent high conviction holdings at one end and a few like slightly moonshotty things at the other end. It's quite similar to my own portfolio. 24 positions probably isn't too many when you have 65% of your invested assets in your top 10. Obviously reminding ourselves of the caveats around things like Adobe and like, low conviction in the top 10. Definitely opportunities to improve, but I think this is a solid portfolio. And it's also like the fact that he's got a spreadsheet, he knows his allocations, he's got a thesis. That is like more than 99% of investors at your age. So like you're on an incredibly strong track and you've got a structure that allows you to improve. So yeah, like well done for that.
Yeah, thanks for pointing that out. I I hope this doesn't sound too harsh. I mean, we were, really addressing very technical, specific things. But holistic, if you pull back and you're a 29-year-old that has 25 positions in mostly really strong companies, and you have earnings coming in, then you're going to win big especially if you refine and take into consideration some of the non-financial advice that we just, like, you're winning more than the majority of people. So on that front, great job.
Now, let's non-financial advice. So that's a good reminder. Let's bookend this section. So we're not going to do these often. Like Patreons, don't be inundating us with your portfolios to review. We'll probably do it once every couple of months. And we did this one because it's quite interesting and it gave us an opportunity to talk about a whole bunch of holdings. So yeah, but everything we said is not financial advice. We're not regulated to comment on this. Every opinion we shared is if this was our portfolio, what would we do? That's kind of the frame. So to our Patreon, don't be trading on the back of the specific advice. Take it on board, have a think about it, but form your own opinions, please, before you do any trading. If you sell Adobe and it suddenly shoots to the moon, that's on you, buddy. That's not on us.
Right. That's right. That's right. Adobe and Duolingo combine and transform into the next $5 trillion company. Oh dear. That felt useful to me. It's really good. It's really good going through the reviews. Monkey has himself 2 new shorts ready to do some fine options shenanigans with those two. So excellent. Badge, over in the jungle, on our Patreon jungle, we had a comment from one of our resident beasties that I refrained from commenting directly because I wanted to talk about it on the pod. And this is a little bit more philosophical, non-investing-ish, but I'm sure we'll loop it back. I'll read the whole comment. Not sure if others agree with me or not, but the first time in a while, I'm generally concerned about how the sideshow of American politics may have a massive negative effect on markets. It appears as though the Epstein debacle is ramping up, with people of influence resigning, a first arrest made in Norway, and pressure mounting on transparency. It seems the first domino has fallen. It now feels inevitable that some startling truths may be revealed, and even if a portion of what is claimed is true, then this administration could be in serious trouble, and the market would almost certainly follow. And I despise all politics, and this is not a political post. It's a discussion on how current political shenanigans may influence markets. Here's Monkey's non-investing retort. As a professor of rhetoric, I know better than maybe most people in the world that rhetoric, by many people's definition, is negative. It's used often to mean the unsavory way people try to persuade others for illicit ends. And it is often tied to this idea of politics, that to be rhetorical means you're trying to pull a fast one over someone. But rhetoric, Badge, is not just the negative, shadowy side. Rhetoric is how we communicate, and the idea that we can't help but communicate something all the time. The shirt I wear, the hat I wear, the way you hold your arms is rhetorical because it communicates something, for better, for worse, for whatever reasons. So you can't not be rhetorical. So that's a little bit of an adjustment. Now, if we take that to politics, here's my pushback. I despise all politics, to me means I despise the unsavory parts about the political process, the fact that it's, let's say, corrupt and ruled by money and all the bad things, right? That's very easy to understand. But if you take the flip side, which is politics means also how people think we should govern ourselves. By what laws, by what systems ought we arrange the way humans do business? You can't have civilization if you don't think about political structures. Otherwise, well, if you can, but then you're back in the woods, right? And back existing in the state of anarchy and, all things go. So we have to talk about politics in this way. And so I, for one, I don't know if you feel this way, I think political discourse should be open. We shouldn't bar political posts. What's the problem isn't political posts. The problem is you pick a tribal side, and out of that tribal side, you think everybody else is bad or evil or stupid or ignorant, and then you start throwing poo. That's the problem. It's not the politics, it's the way you talk about politics. So I appreciate this posters wanting to caveat, it's kind of an implied, I know most political conversations are poo slinging, so he's wise to not want that. But we should talk about Epstein, right? And we should now bring it to the investment angle. So what do you think, Badge?
Yeah, I don't disagree with anything you said. But I think maybe in asking this question in the Jungle Lounge, which is an investing forum, I suppose our Patreon here, Bengal Tiger, he's asking a different point. Like what he's saying is there is all this stuff happening in the world and it's complex and, who knows what the ramifications might be longer term. How should I think about that as an investor? I suppose that's like the nuts and bolts of it. And you're right, we should have these difficult conversations and, bad things have happened. And in my view, people should face the consequences of their actions. Unfortunately, the world is such that may or may not happen. But if we focus on the investing angle, I suppose, we are an investment podcast, not a political podcast. I suppose, should you hedge against this stuff? Should you, how should you kind of factor it into your portfolio strategy? And maybe it's a bit, I don't know, is it distasteful to even talk about protecting your wealth when, it's something as unsavory as the whole Epstein situation? Maybe just put that aside. I personally wish that people face the consequences of their actions. I'm kind of skeptical, unfortunately, that will happen. Probably won't. But if it did, it's probably a good thing in the long term, even though it could create massive volatility and turmoil in the short to medium term, while, maybe certain people end up not in the position they're in today. And, who knows what that does to the investing environment. But if as a long-term investor, I'm just kind of neutral to this stuff. I'm just going to weather whatever storms may come.
Right. My own investment takeaway is this is mostly non-actionable. And probably because this is always the case. I mean, when have human beings not been corrupted by money and power across the centuries? Right? And so the only time monkeys ever really been bearish has been due to what I thought were economic red lights flashing, debt spirals and, credit card defaults and that kind of thing. But the political stuff, I don't know. Let's say a big scandal breaks out and then a big scandal has broken out, but let's say a bunch of big names get, to your point, let's say charged and found guilty. Presidents or heads of state or whatever. Okay, so the market has a couple big red days, and then what are the institutions going to do? They're going to come in and swoop up all the shares for cheaper because it's going to, the next scandal's just around the corner. So,
if you maybe something actionable, and I've got no idea, if you think the CEO or the founder of a company you're invested in is going to get, suddenly come under fire and maybe face the consequences, that might be actionable. That might be a risk for that company. But when you're looking at, as you say heads of state, it affects the whole market. You probably, it's just the background noise of an investor. And it's one of the many things that drives, the big macro 7-year cycle. You just have to weather it.
Right. And maybe to put a nuanced point on that, there are only a handful of people I could think of that are, say, integral to the company. If Musk was put in jail, that would be devastating to Tesla, I think, at least in the short, medium term, no question. But how many instances are, most of, yeah. And I hate to be cynical. This is to your point. What we're talking about here really is a network. It was this gigantic network of whatever Epstein was. He was kind of like a master puppeteer network, like flywheel effect, that the larger his network grew, the harder it is to disrupt it because you have millions or billions of dollars flowing from this person to that person and no one wants to call anything out. So sort of like a Facebook, it was like too big to fail kind of thing. I have a hard time seeing. I wish it wasn't the case, but
it's certainly outside of our control. Like everything we talk about on the podcast is out. The only thing we can control is our portfolio construction and our reaction to the markets and our own emotions, right? But what happens in the world happens in the world. Like we're just complete nobodies when it comes to such things. So like some stuff you just have to not worry about.
All right. Yeah.
Okay.
So Badge, don't worry about the Epstein stuff. Just enjoy your snow.
Well, as long as you're not in the Epstein files, I know I'm not, then I think the podcast is probably safe.
Well, Monkey does like islands. And he does like a chartered flight every now and again. I suppose a little self promo here, Badge. I really have been in the dungeon working on the options course now for a long time. I polled our Patreons whether I should just get over it and release it into the wild, in a imperfect state. The feedback was overwhelmingly positive that I should in fact live fast, die young, rather than suffer from perfectionism. So I hope to have it out within a week. For the first public iteration of it. So stay tuned.
Awesome. Yeah, we're looking forward to getting it out. I know you're buried in trying to snag the last few problems, but we'll have that out to our Patreons very soon. If you're interested in signing up for the options course, the best place to start is to go get yourself over to wallstreetwildlife.com, where you'll be hearing about it first.
Oh, that's right. This is worth announcing. Only Patreons will have the deep discount. And I thought that's wise because we're building a community first, and that's an incentive for anybody to actually become a member of our community, because you get a sweet 30% discount, which is meaningful. Hopefully we get more jungle critters.
Yeah. And just as a reminder, I will say, there's value in the options university for lots of kinds of investors, even if you don't want to do short-term stuff and shorting and looking for returns within 1 month by betting against companies. There's a lot of learning you've put in there for long-term investors around insuring your portfolio against a downturn, around being able to earn an income from investments that you have. So yeah, there's lots of ways to get value from that investment in the Options University. Good job.
Awesome, Badge. All right, you heading off on the mountain?
Yeah, let's see. I looked out the window. I still see no snow, but we'll decide. Before we close today, we didn't talk about our partners over at Fiscal.AI. We do use it every day. If you use Fiscal.AI/wildlife, you'll get 2 weeks free of Fiscal Pro and a 15% discount if you upgrade. So do check it out at Fiscal.AI/wildlife.
You ready to become a beastie, Badge?
You start right here.
A reminder that the people on this program may hold positions in the companies that are mentioned. Buying and selling stock carries financial risk, which could include loss of capital. The views in this program should not be taken as personalized advice. Before acting on any of the information provided, listeners are encouraged to consult a financial or tax professional.